Hey, it's Richard with Matthews Wealth Management. We're going to do our March 2021 market update here. Pretty numbers intensive. We're going to be going through all of the asset classes that we follow using modern portfolio theory, just to kind of see what's been happening over the last couple of months. And if you'll notice here, we'll just jump right in. We've got a 1 month number just to show what happened from the beginning of March until the end. And normally I'll do a 3 month look back as well as a year to date. Obviously for March, the 3 month is the year to date. So this will be just 2 columns to go through. But I think the trends that we'll uncover are pretty noticeable with just the 2. So let's go ahead and take a look real quick. So large cap value, big companies, the cash cow, dividend paying type stocks here. The last month they're up 6.71. Then we go to large cap core or blend at 5.18. And then on growth, we're finally seeing an inversion from what pretty much all of last year and maybe some of the year before. It was just a growth boom, right? Everything was going for Apple and Tesla and Amazon and eBay and all of the big tech products were taking off. And a lot of that had to do with money that was coming in from the sidelines or from stimulus money or whatever the source may be. And we're starting to see that trend reverse. As we go into mid caps, the exact same thing. We're up 6, but we're down 3. So this has been good. This is based on what we were hoping to see going forward. We see it continue into small caps as well. That there's been a bubble. There's been a growth bubble. There have been a lot of bubbles in different areas, different industries, different types of investing into these equities. But the overall trend is reversing, at least on the 1 month. And we'll come over and cover the year to date because we're seeing the same trend. Black and red kind of show it for us. But yeah, this is what we were expecting. I was almost going to say normal, but this is not normal. It's just what it is. So a little bit of unwinding is what we're seeing from these higher risk areas. So a little bit of interest here in the international and emerging market stocks. International is up 2.4% and emerging market is down. So I think that's another de-risking that we're seeing across a lot of these big managed funds. So if you think of a Fidelity 2040 Freedom Fund, that's a target based on a risk tolerance. It's a bunch of movement between equities and international and bonds and cash, and these things are supposed to be just set it and forget it. And a lot of these trends are starting to show some de-risking. We see that in some other industries, some other asset classes as well. But the big story here of what's been happening over the last month or year to date is going to be in the world of bonds. And it's not fun to talk about because interest rate risk and things like that get a little bit technical. The bond market is probably the least understood out there. So this makes sense, honestly. First of all, the first thing to see, tips and then short-term, intermediate, long-term, they're all negative, but they're negative in normal proportions, right? And so that's part of what we use modern portfolio theory for, is to identify trends and correlations, right? So correlations are, well, when stocks are up, bonds are down. When bonds are up, stocks are down. That's a negative correlation here. This is a positive correlation because they're all down, right? They're all in the same direction of 0 and to varying degrees based on longevity risk. So the shorter the term, the less amount of risk of actually getting paid back. If we're talking treasuries or corporates, it's a different metric there for risking, but just for term, this makes sense. The big thing to notice is long-term bonds, right? So if you follow along at all with the newsletter or any emails or client meetings that we've had, the 10-year treasury has been of particular note throughout this quarter, basically because we're seeing there's not enough liquidity to be able to purchase the debt that the treasury is writing. And normally the Fed picks that up, but the Fed is having some issues with their interest rates, and it's really reflecting in the 10-year treasury market, and we call that yield. So you're watching treasury yields go up pretty drastically in March. And so what we tend to look at for the 10-year treasury, I think right now it's 1.70 yesterday maybe. I'm not going to tell you what today is, but yeah, it's in the 1.7s. And that's really flown up here recently, and that puts a lot of difficulty in the face of the Federal Reserve on what they're going to do with the yield curve. And anyway, it's a very interesting, pun intended, discussion here about bonds, but this does make sense. We did make a big move back in the end of February with client accounts here at Matthews Wealth Management. This is one of the areas that we have not picked up the right direction. I feel like it's a timing issue, like this still works itself out in the long run, but long-term bonds have taken, I'm not going to say a big nosedive in March. They took actually most of the nosedive last year and then into January, February. And what we're starting to see is the deterioration of intermediate and short-term bonds. So a lot of the long-term bonds, we moved into long-term bonds pretty heavily at the end of February. And that's not good for me to see, but for clients out there, it's just not the right timing yet. We're going to see why we did the long-term bond play, hopefully into the future. There's still a reason that should pan out. So high yields, like I said in the last one in February, it's the safest place to put your money because that's what the Fed's buying off of the market right now. So they've taken the risk out of high yield. We do have a pretty decent amount of allocation in high yield bonds, which should be highest risk, but in this, they're backed by the buying power of the Fed balance sheet. So that's why we're seeing positive numbers there. It's been a very safe bet over the last year. Real estate is still continuing its climb. And this isn't, don't think residential real estate. There is some residential in here, but a lot of this has to do with commercial or storage or REITs or different types of real estate, a lot of debt type of real estate. But I still expect that to drop at some point. We haven't started foreclosures or evictions yet. As that starts, you'll see prices plummet. So profitability obviously will plummet as you lose those tenants. So anyway, real estate looking good, still doing good. Gold and silver have kind of fallen off the face of the earth, and there's some downward pressure in commodities pricing right now. There is an unusually high amount of physical delivery in commodities, which is kind of fun to see. You don't see it very often, but people aren't just taking others at their word anymore. They're wanting to show me the money, I guess, so to speak. So oil being down 3.7%. Oil was an interesting, energy in general was an interesting play going into March. Those big funds that kind of decide where money is going to go based on algorithms or equations. There was a lot of money that was going into the energy sector, including oil, and I think we did a good job capitalizing on that when we did. We've still made some very good money in that sector, in that asset class. So over the last month, the month of March, the S&P was up 4.38. It's a nice average number for stocks, the stock market, so to speak. NASDAQ would represent more of the growth, Russell 1000 for more of the small caps or mid caps. So there's different, I guess, benchmarks that we'll use to classify different things. But when people say the stock market, think S&P. So 4.38. A Dow Jones moderate portfolio, which is like a 50-50 stock bond type portfolio, was under 1% for the month of March. So this is the first time we're seeing a fairly large discrepancy over being full risk on and then half risk, as we would look at a moderate portfolio to be. So usually we'd see somewhere around 2.5 or 3. So the moderates were pulled down a lot by the long-term bonds, as well as oil, and then you got the growths that are pulling it down as well. So bonds in general, that's why the moderates are falling behind. So let's talk about year to date and how to think of year to date, because I don't typically do this in videos, but my mind is in terms of ratios and percentages and so forth. So if we're from January up 10% large cap value, and almost 7 of that just came in 1 month, this is a more recent trend, right? This is making a bigger percentage than 1/3 of 10%. So 2/3 of the return have happened in the month of March, which is how I'm reading this. Large cap core is up as much as it is because of the last month of March. Same thing, most of the growth has fallen off because of the month of March, et cetera, et cetera, et cetera. So we're seeing a very big shift in these trends, which not only happened in March, but has now pulled the year to date in a very distinct direction, and it outlines the exact same thing. So small cap value, that makes sense, right? That's 1/3 of the 21, so that's what we would expect. That's a little short for small cap core, and a big swing on growth on the small caps just diving on growth in the last month, and they pulled them down finally to negative for the year. See International, this was a big swing to have such a big drop when we were positive. So the comparative way to notice what's going on in the 1 month or 3 months / year to date column is just how much of the gain or loss have we experienced most recently. And so that's how you can pick out a lot of this information. Same with gold, it's only down 1% in 1/3 of the year, as opposed to being down 10% for the entire year. Oil, this is where I said I'm glad we made the moves when we did. Still up 22% on the year, even though more recently there's been that drop. And I think a lot of that has to do with the big money managers that are shifting these allocations. Most of the gains in the S&P happened in the month of March. We're still up 6, but you can see most of the gains in the moderate happened January, February, hence only the 1 here. So yeah, hopefully that explains a little bit of how to read what we're looking at on a timeline, because it shows you more of a trend in terms of what's moving when, if you can break it down that way. So let me jump real quick to, we'll just do the year-to-date practice for Matthews Wealth Management. Our best account is up 30%. Our worst account is down 3. Our average is 2.11. As you know, I like to beat this number at the bottom just because in general, most of my clients are retired. And we're doing a little bit of capital appreciation, but mainly income management, tax management, and so forth. So I do like to beat this with less overall volatility, is kind of what we say on these things. And we're not beating it for this year. This has been a strange year. That first quarter was one you don't typically see, just the huge numbers of swings of how things are going. But in general, 211, we'll take it. We're taking less risk than the moderate, so I'll be happy. The big picture here is, I told you at the end of February, they've stopped tracking M2 money supply, and they went back and they reclassified what M1 is actually made up of, whether savings deposits are counted, or what is cash, what's the difference in checking and savings. For people like us, if I've got 5,000 in savings and 1,000 in checking, or if I just have 6,000 in checking, most of us is the same thing, but apparently they want to say that there's a difference with how they calculate all this. But what we have now, what they've updated it to, which just replaces all those old numbers that I had up here, is the M2SL. Go figure, they're just throwing something new so that you can't keep track of it. But what that says is that we have $19,677,500,000,000 in M2SL. So for the next 60 years, I hope this stays the same so we can see what that actually means. But going back on the weekly averaging of these numbers, the last month we've gained 1.24% more dollars. And you know, I basically am defining this as inflation. Whether we see it in asset prices, which is most likely, or whether it trickles down into expense and CPI, for whatever that matters, take that for what it's worth. But for tracking this plays a big deal in what happens with asset classes. So it's important to me to look at these numbers. And then if we go year over year, March to March, that's 26.82% inflation, right? So I think at the beginning, or at the end of last year, it was 24.7. So you can see we still have a trend line of inflation accelerating. The Democrats and Biden have proposed more spending. They've proposed more taxation. I heard a great little question, if we could just print all the money in the world, why do we need to pay taxes? It's a good question. If somebody has a legit answer, I'd love to hear it. But it seems like a weird curveball that's coming to the financial markets and how we handle that. But yeah, so we've got a lot of inflation on the way. We've got some more taxes coming in to eat away some earnings and profitability of companies. So in general, we're positioned, I think, where I want us to be. I don't think there's much that we need to, look back on and kick ourselves about. Everything is played out properly, except for a little bit of timing here on the long-term bonds and the real estate, for that matter. I've cut back real estate a lot, so when it makes 5%, that's a little frustrating. That might be where my 211 came from instead of my 253, but anyway, those are more or less timing issues which we don't follow. So Hope this has been helpful. If there are any questions, feel free to reach out, email, phone call, set up a time, catch me around Fountain Inn. We'll talk about it, but hope this is helpful, and we'll just see you next time.